Hi, everyone. Welcome to the first video in Nonprofit Finance Fund series, A Beginner's Guide to Debt for Nonprofits. In this video series, we'll share information about debt that's relevant to first-time nonprofit borrowers, including how debt can be used as a powerful tool to achieve your organization's goals and deliver on your mission. As a lender and nonprofit ourselves, NFF sees firsthand how nonprofits use debt strategically to deepen their impact. And this series pulls from our more than 40 years of experience lending to nonprofits, including ways to know if debt is the right fit for your organization, how to successfully apply for loans, and how to manage debt well so that it helps you achieve your objectives. In this first video, we'll define debt as a financial tool for nonprofits, both what it is and what it's not. And then we'll name some reasons why nonprofits borrow money, and we'll talk about different types of debt products available to organizations, including the needs each can help fill. So, what is debt? At its most basic level, debt is money that's borrowed, which needs to be paid back to a lender at a predetermined and agreed upon time. But thinking a bit more conceptually, debt is really just a financial tool that many nonprofits will utilize to deliver on their mission. So, something we'll repeat several times in this series is that debt, or a loan, can never replace critical pieces of an organization's business model, like revenue. Because debt always has to be paid back, it's really important to note that it can never be used to replace revenue. Rather, debt can support issues related to the timing of revenue coming in. It could be a good financial tool for a nonprofit when they do not have the money they need for something today, but they know that money will come in the future. So to provide an example, a nonprofit might seek out a line of credit, which is a loan product that can bridge delays in payments from things like reimbursement-based government contracts. And in this case, the organization knows that this revenue is secured and will come in, but it's just not available right now. In this case, debt can be a useful tool to bridge the gap in timing and avoid any interruption in your programming. And with that said, we'll also note that good uses of debt should always be attached to the mission. So if it's not directly or indirectly helping you achieve your mission, then debt probably isn't the right financial tool. And really, what the goal of this video and this workshop series is to help nonprofits understand how debt works, including when to use it and how to use it without smashing any fingers. So that's why we also want to be clear about what debt is not. And debt is not a grant and it's not revenue. And we recognize that many nonprofits' first loans were through the Paycheck Protection Program, or PPP, during the COVID-19 pandemic. And many organizations had their PPP loans forgiven, but this is really atypical and uncommon for most loans that nonprofits have. So we want to state early the ways that loans are different from things like grants, because in many ways, PPP blurred those lines. So first, we'll look at how debt can be similar to grants. And really, both grants and loans require building and maintaining a strong relationship with either the funder or the lender, and that it's really a partnership between both parties. And that partnership is really established through a good flow of information with open communication, both from you as the borrower to the lender and from the lender to you. And again, this can really help build trust, strengthen the relationship, and just make the whole process easier for you. But we also want to note that for most loans and grants, more information tends to flow from you as the borrower to the lender, and less information tends to flow from them to you. And this is just to make the point that it's really important to always ask questions of lenders around all components and requirements of the debt, so that you're clear about its terms and you're confident that you can pay it back in full and on time. So we'll also talk a bit about how loans are different from grants. And the first one, this may be obvious to many, but a grant is a gift from a funder and it does not need to be paid back. However, a loan does need to be paid back. So while grants are considered income and they appear on things like income statements, debt or a loan is a liability that appears on a balance sheet, which is really a financial snapshot that shows everything your organization owns and owes at a particular moment. And another key difference is that loans have costs associated with them, things like interest and related loan fees. So while grants usually do not have those fees, we name this because it really does cost money to borrow money. And this doesn't mean that it's not worthwhile to take out a loan, but it's just something to be keenly aware of and plan around financially through the duration of the loan repayment period. Reporting is also something that will look different between grants and loans. So while grant reports tend to be narrative, loan reports due back to lenders tend to be more oriented to your finances. So things like monthly or quarterly income statements, balance sheets, or other financial documents. So while a grant officer might focus reporting questions on the impact of your programs, a loan officer is typically more interested in understanding the numbers, really with an eye towards understanding your organization's continued ability to pay back the loan in full and on time. And then lastly, we all know that simply qualifying for a grant based on its criteria doesn't guarantee you'll be awarded that grant. Kind of conversely, with a loan, if you meet the lender's criteria, and we'll talk more about what that criteria looks like a little bit later in this series, then generally speaking, you'll be approved for that loan. So if the lender determines your loan is a safe bet to be repaid, there's usually little reason to think that they deny your loan application. And while some more traditional lenders may be solely focused on your ability to repay that loan, many community development financial institutions, or CDFIs, which Nonprofit Finance Fund is, will also want to make sure your loan supports your mission. So with all that, you might be wondering why an organization would borrow money if it has to be paid back and it costs money. But borrowing money can fulfill a specific need that can't be met from other funding sources. And one reason many nonprofits borrow money is because it can provide them with the working capital they need to operate, grow, and manage risk. And working capital is essentially money that every organization needs to cover its regular day-to-day expenses. And some working capital loans, so things like lines of credit and bridge loans, provide organizations with faster and more reliable access to cash as compared to grant or contract revenue, which might not show up in your bank account as cash until weeks or months after you've incurred those related expenses. And those working capital loans can help organizations also manage swings in revenue. So, for example, a working capital loan can help bridge the gap in covering regular expenses, things like payroll, during points in the year when cash tends to be low. So perhaps due to a busy schedule of summer events with higher related expenses and lower available cash in those summer months. But many nonprofits also will borrow money for longer term needs that can't be covered from grants or revenue alone. So things like purchasing equipment or acquiring a building. And for example, some organizations may have a capital campaign for one of these longer term needs to raise funds for a big facility project, for example. But the funds that that capital campaign generates might come in after you need to pay for project-related costs. And in this case, taking on debt could help bridge the timing gap and ensure your organization has enough money when it needs it to keep all of its work moving forward. And we'll talk too about different types of debt, and different loan products are used by nonprofits to address different challenges or opportunities. Some of them are related to working capital. These include things like lines of credit. And these loans work somewhat similarly to a credit card, where essentially a lender makes cash available to a borrower to use when it's needed up to an agreed upon amount. And the borrower has to pay interest on the amount of that line that's used. And as soon as an amount borrowed from the line is repaid, it then becomes available to be borrowed again, which is why we call it revolving. And lines of credit help nonprofits with the cash they need based on the timing of revenue coming in from things like donations and grants. And the second type of working capital loan is a bridge loan, which can really help organizations with these are short-term loans that are used to bridge timing gaps between when an organization needs to pay expenses with when it receives actual cash payment from a funding source, typically in a lump sum. And bridge loans can be a good solution when funding for a project has been awarded, but there's a lengthy wait for those funds to come in. So, for example, an organization might be engaged in a capital campaign for a new project, and a bridge loan can provide the organization with the working capital it needs to proceed with that project while it works on converting campaign pledges into cash. But other types of debt can be used to support one-off projects or larger projects, including purchasing and maintaining fixed assets, so things like property and equipment. And this could include the purchase or redevelopment or construction of a building or a piece of land, or even the purchase of a shuttle bus for clients. And then lastly, we'll just note this distinction at the bottom, which is that whether debt is used for working capital or fixed assets, it's almost always secured. And this means that the loan is backed by some type of collateral, which is owned by the borrower, that the lender can look to if the loan is not repaid as expected. And a secured loan really designates a specific asset owned by the borrower that can be used as a backup form of repayment if it's necessary. And some loans may be unsecured, meaning there's no collateral, but really this is less common. That's it for this first video on defining debt. If you have other questions about debt and the lending process, please take a look at our other videos in this series, which you can find on NFF's website below.